Hi, my name is Jeffrey Day. This is a Gatekeeper presentation for Dr. Schneider's Management 686 Corporate Governance class for the 2017 summer session on credit rating agencies. In this presentation, we'll start by looking into the credit rating agencies and where they are, who they are, when they're important. Credit rating agencies assess the risk of debts and issuers for the bonds. The company needs bonds because they need to raise capital for growth, and government issues bonds because they need to support their infrastructures when the tax revenue is not enough to fulfill their obligations. In the mid-19th century, the United States was experiencing the railway industry boom, and everyone was racing to build and stake their claims in the industry. Thus, there is a massive demand for the loans as the railway company borrows money to build the railroads and pay their workers. In order to obtain the loans, railway companies issue railway bonds to attract investors. However, not all railway companies are created equal. Investors needed a way to assess the railway companies and the bonds they issue, and this is where the credit rating agencies enter the picture. In the credit rating industry, there are three major players: Henry Varnum Poor, John Moody, and John Noel Finch. All three of them started as publishers. Henry Porras was the first to publish about railway companies. He learned about railroad industry through his investment in the Maine timber industry. In 1860, he published his first report in his American Railroad Journal. Later on, he compiled those reports into a book named Porras' Railroad Manual that assessed the railway companies. In 1909, John Moody, under Moody Company, he published the first bond rating on the railroad industry. This is the first time we see the use of letter rating scales, which is still being used today. Then there's a third player into the industry, John Noel Finch, who in 1914 uses Fitch Publishing Company to publish New York Stock Exchange weekly statistics. Those three that we mentioned in the previous slide basically form the big threes in the credit rating agencies. They basically have established a credit rating oligopoly model in the industry. Between Standard & Poor's, Moody, and Fitch and Rating, they dominated 90% of the credit rating market. Credit rating agency had their origin as a publisher, so they started with a subscriber pay system, where subscriber pays for the information on the bond issuers and ratings assessments. Under the normal circumstances, this payment arrangement is normal and works. However, the first conflict of interest is when rating agencies collects fees from the corporation to rate their bonds and list their bonds. For corporations, they see this as part of the cost for the loan because a rated bond can attract more investors. However, because the agency collects money from both issuers and the investor, the objectivity for the rating becomes questionable, as which client are they serving. The conflict of interest is a concern because it is largely unregulated industry, and the agency is acting as a dual agent. So in terms of who they serve becomes questionable. Now, to make matter worse, in 1936, in the post-Depression era, the U.S. Office of Comptroller of Currency prohibit banks from owning speculative investment security, which is based on the agency's rating systems. So in essence, the U.S. government had made the credit rating agency the gatekeeper for what the bank can own, what a bank cannot own as an investment. Aside from the conflict of interest, credit rating agencies have other issues. The rating is legally considered opinion. Thus, by law, credit rating agencies cannot be held liable for negligence for false ratings. Even though the agency is not held liable for inaccurate information, their rating does matter because investor depends on their assessment. They all have a limitation on warranty and liability clause. So investor basically assumes the risk, and the agency is not held accountable for their ratings. Now, the issue of accountability was addressed to some degree in the Credit Rating Agency Reform Act of 2006, which allowed SEC to impose sanctions against the agency. However, this is limited to the use of misguided information which they intend to commit fraud. So to some degree, they are still not held liable for their rating. Now, the rating is also prone to cyclicalities of the economy. And what that means is, if the economy is in an upswing, the company's bond tend to receive a higher rating and stays at that level. When the economy is on the downswing and it has a hiccup, the rating drops. And when the rating drops, the company falls under tighter scrutiny, which could propel the rating to spiral downwards and turning a minor incident into a major event. Then there is also the forecast model, which is based on historical statistic data, a backward-looking model to predict default rate rather than a forward-looking model. The agencies also provide government bond rating as public service that is free of charge to the government. However, this relationship is an interesting one, as nations need to have high rating to secure low interest in the international monetary market. These relationships came under stress in 2011 when S&P decided to downgrade the U.S. AAA rating to AA+. When the U.S. raised their debt ceiling, this drew outcry for the government and the Obama administration. They argued the agency calculation was incorrect, but nonetheless, the U.S. rating remains at AA+, and the outlook stays at stable. Another government had the same situation with the U.S. is Greece. During the Greece financial crisis, at the lowest point, S&P was rating Greece with triple C's with negative outlook. The argument from the EU is the rating is too harsh on Greece because the agency did not take into the consideration of the economic relief package the EU central bank had prepared for the Greece. Another area credit rating agency creates a conflict of interest is the complex financial product. Working in collaboration with the client, agency package together base value derivatives with high-risk loans. So there is no good way to truly assess the risk of the package bonds. The process is so complicated, the financial information is asymmetrical to the competing agencies. So the competing agencies are unable to accurately assess the package product and conclude the probability of the default risk. During the 2007 financial crisis, credit rating agencies were accused for sugarcoating the loans, not reflecting the true risk, and they need to be held accountable for contributing to the subprime mortgage crisis. During the Senate hearing, S&P executives admitted that they had made mistakes and their analytical models were old and not sufficient for the modern-day financial market. And all this led to the Credit Rating Agency Reform Act in 2006 and the Dodd-Frank Wall Street Reform Act in 2011, trying to bring accurate accountabilities and introducing more agencies into the industry. The credit rating industry have their share of industry problems. These problems are conflict of interest with the client, biased opinion, lack of transparency, accountability, outdated financial models, and oligopolies. To address these issues, I think credit rating industry need a reform, starting by removing the conflict of interest. This can be achieved by introducing intermediary agents, so the bonds are not registered and listed by the accessing agencies. Leaving the credit rating agency, the only task is to assess the issuers and the bond. The intermediate agent can solicit at least two agents to assess the debts. Then the credit rating agents can sell the information to their subscription clients. In order to have better transparency and accountability, the industry needs standardization on how the debts are assessed. When the process is standardized, there is a baseline established for monitoring agency to follow and allow transparency of the assessment of the debts. Between the use of intermediary agents and standardization, smaller credit agency companies can enter the industry and compete against the big three, remove the oligopoly model in the industry. Then there is a monitoring agent in the U.S. We should leverage the Financial Stability Oversight Council and SEC. However, I don't think the U.S. should go alone on this one. Instead, the U.S. should involve the international agency to establish global financial monitoring system because credit rating agencies' jobs are too important to the global economy. And this concludes my presentation. Thank you for your time and wish you all a happy summer.